Vitalhub Corp, symbol VHI on the TSX. Price is $270. Market cap $117.78 million. A description of the company. Vitalhub is a software consolidator focused on the healthcare vertical, primarily in the electronic medical records and patient flow solutions area. But the technology is provided to health and human service providers, including hospitals, regional health authorities, mental health, long-term care, home health, communities, and social services. The company has a two-pronged approach, essentially, to its growth strategy, targeting organic growth opportunities within its product suite and pursuing an aggressive M&A plan. Currently, Vitalhub has more than 1,000 clients across Canada, the US, the UK, Australia, the Middle East, and Europe. So let's look at the company's most recent financial results. Its second quarter 2023 revenues increased a healthy 38% to $13.08 million. EBITDA rose to $1.97 million from $1.02 million in Q2 2022. Adjusted EBITDA rose to $2.97 million, or 23% of revenue, compared to $1.87 million, or 20% of revenue in the same period last year. The increase was primarily attributed to higher recurring revenues, which is a good thing. Net income before income taxes rose to $742,000, up from a net loss, or basically break even, over the same period in Q2 of 2022. The increase here was primarily attributed to significant increase in revenues from organic growth and acquisitions, and lower expenses as a percentage of sales. EPS was 2 cents per share, from basically break even or nil in 2022. So what are the valuations on the company right now? Well, the PE is high, but if you look at the company on a EV to EBITDA basis, or just an EBITDA basis, it is net cash. The company is about 7 times fiscal 2024 EBITDA, versus some of the software consolidators out there that trade at 12 to 14 times, albeit they are many of them are much larger entities than Vitalhub. Our take here: historically, Vitalhub has funded its acquisition strategy via equity financings or selling shares. It has tried to walk a tightrope, creating accretion to cash flow per share in the face of share dilution. I would remind viewers that the company has once consolidated its shares, as its aggressive acquisition strategy led to a high share count, depressed share price, and it was forced basically to consolidate and continue its acquisition strategy via issuing shares. Now, our question here is, has Vitalhub now reached a critical mass point whereby its free cash flow production can be recycled into strategic and accretive M&A? There are estimates this year for free cash flow to be in the range of $10 million. So the balance sheet, from some financings and now positive cash flow, the balance sheet remains well capitalized with about $20 million in net cash. They have access to $27 million in an undrawn bank revolver. All of this is to continue their M&A strategy. Management stated that Vitalhub continues to see solid deal flow across tuck-in and larger transactions, with the larger transactions being more preferred. The stock trades at around 9.3 times 2023 expected free cash flow, which is not a bad multiple if organic growth can maintain its current range. The current range is about 4%, but we'd prefer it to increase to the higher single-digit range to be the most attractive. Now, of course, if it was well beyond that, it'd be more attractive, but that would be a reasonable rate. Now, we see potential in Vitalhub and continue to monitor it. We likely interview management once again in the near term. Right now, we're on the sidelines, but it is interesting after that quarter, and the fact that it is generating some free cash flow and has that solid balance sheet. And what I would like to see from this company is, unless they're trading at a premium valuation, don't issue more shares. Just pick off opportune acquisitions at reasonable prices to grow via acquisitions, continue organic growth, and use that free cash flow generation. Maybe grow at a little slower rate if you have to, but don't issue many shares unless you are starting to trade at very premium valuations, because it is difficult to be accretive if you keep issuing shares over time. So it's an interesting business, and I do think that there is a significant recurring nature to the business now. And if the free cash flow continues, it could be a situation that we want to dig into once again a little further.